We're in a different world now. We're not in the normal bull market of 80 or 2011 gold and silver. The events that are going on around the world in terms of markets, economics, monetary stuff, and now something we'd predicted months ago before Trump was even elected. We said if he were elected, it would be uncopacetic in the streets. Not that it was uncopacetic to have that outcome. It was just that what would happen would be perceived as, disturbing ultimately, and it would show itself in the streets. And I think that's just begun, but that's not a causal factor. That's just an echo effect. Big things are happening in some big markets that will further impact what the monetary metals are doing, meaning go up, but then suddenly go up more and more accelerated. And that is, there's two markets in particular we're watching. And one, I think the stock market's topping. Okay, we thought that back in late last year. I say the same thing now. Do not trust it. If it makes a new high, don't believe it. First off, if you look within the stock market, you'll notice that your leadership is gone. Yeah, Nvidia is still up there and it hasn't even made a new high, and Microsoft. But you go through the other big seven, and suddenly, what's going on here? I'm where I was in 2022. The leadership is fragmented, and too many sectors aren't participating in this. Too many key sectors aren't back at their highs. So don't trust it. Momentum says you made a big stumble in the first quarter of this year that can't be shrugged off. Whereas you could try to rally and even maybe make a teasing new high. The major momentum trend is now negative. Okay, now, but more important than that, the dollar. When you measure the dollar versus the euro or the yen, they're two pieces of fiat stuff, who cares? But that's what we measure when you look at the dollar index. And the dollar index made a high in 2022 up at 115. But then in 2023, it collapsed down to 100. And then for 2 years, the dollar index went between 100 basically and 108, just up and down and up into 2 full years of nothing, where it really wasn't creating any waves or consequences. It was just Dallsville. A lot of volatility elsewhere, but not in that market. In March of this year, we dropped down from the upper end of the range that it had been in down to 104 area. We turned major bearish at that point, saying, okay, major bear trend is going to unfold now. Not just congestion. It's going to wake up to the downside. Since then, we've dropped down into the 99, 98 area. A month or so ago, had a rally back to 101. Right now, we're back under 98 again. We broke enough stuff in March at our 104 level to say, okay, it's underway. We've got one final number that is so negative if you close below it that it says Bombay door opens. And that's closing out any month this year below 98.35 to give you the precise number. You close below that number this month and 10-year average momentum says you've broken your backbone and you're going down probably swiftly. I wouldn't be shocked by a 10, 20 point more drop pretty quickly. That will cause disturbances and wave effects in other markets, particularly foreign money that owns bonds, government bonds, or foreign money, which has never more been so important in the U.S. stock market. Never before have we had such a major foreign buying of the stock market in the U.S. than the last couple of years. Not only is they're price sensitive to what happens in those markets, but also to the dollar. Because if you own T-bonds in dollars and the dollar drops 10%, whoa, you're not only getting hurt in the T-bonds, but you get hurt in the conversion. Same true with the S&P, for example. So I think that dollar breakage is going to have some wave effects that it hasn't had for the last 2 years because it's been fairly dormant. And that's an area that not many people are talking about because they don't know that getting to where it is now is really that important. It is. And I find it very interesting that the dollar is doing what it's doing at the same point in time that silver's resurrecting itself. It's too coincidental. Maybe it's not coincidental. Maybe it is that you're going to have fractures appearing in different markets at the same time. What we debate on the dollar index is merely the relative degradation of one versus the other. They're all degrading in real value because, they pump up the money supply, increase the quantity of money, therefore you reduce its actual underlying buying power. Like, your granddad, when he built a home, was $4,000. Now it's $40,000 is the median price. What's going on? Well, it's the degradation in the money unit. The same is true with a lot of assets, stock market as well. It's not even keeping up with the degradation in the money unit. Stock market isn't, the S&P isn't. It looks great on a chart. We ran a chart in a report a week ago just for fun. The Venezuelan stock market. Talk about degrading your money. We know that. We know they pump, it's paper. It's like the Weimar Republic. That stock market's just blowing off the page. I mean, you say, gee, I should be in that market. You probably buys fewer loaves of bread now than it did 3 years ago. It's meaningless, in other words. So sometimes when people focus on just the nominal price of something, they're missing the point. It's degrading in real value, whereas monetary metals over time hold their value. And I think there's a re-realization of that now among a lot of investors that, gold's been doing well, not just nominally, but it's been holding its real buying power. And silver's lagged. We know that. When we study the relative performance of silver to gold, we know it's at very, very low historical levels. Silver getting down to under 1% of the price of an ounce of gold is very low historically. You can go back and find instances of it. And by the way, whenever you did, you want to be a buyer of silver then. It's now up to 1.1%. So it's gained, some in the last month or two. It's starting to reassert itself. Same is true with the gold miners. The gold miners, on a relative basis to gold, have been basing and actually firming up over since 2015, the bear low in all the metals. They've appreciated actually a bit more than gold. It's hard to believe when you look at a chart because it looks so irregular, but actually, if you'd bought GDX in December 2015, you're doing better than if you bought an ounce of gold. But they look like they're ready to now accelerate their resurrection. They're coming out of this vastly cheap hole on a relative basis to gold, and similar silver relative to gold. So not only is silver broken out of a momentum situation that says it's about to shoot up in a more dramatic way, but its spread relation to gold and the miners' spread relation to gold says the same thing. It says, we're waking up, we could jolt you in what we do over the next handful of months in terms of, wow, I wish I hadn't gotten out of my miners. I think that's where we are right now. It's, I think, delusional. It did enough long-term momentum structural trend damage coming off the 2024 highs to argue you're topping. I remember vividly back at 2000 dot-com high, which was far less of a bubble than we've got. It was primarily, the excess in that leading sector, internet. We got bearish in January 2000, said, be gone. Okay, well, it dropped into March. Looked like we were right? But then it came back up and a couple of months later made a new high. So it looked like we were wrong, but we held to our view that no, you did too much damage in January, February to shrug off. You've broken your leg bones, okay? It labored all during 2000, flip-flopping either side of where we said get out. But it made price chart watchers feel comfy. Because, hey, it wasn't dropping, cool. 2001, it started to fall apart. Took it a while. Similar behavior occurred in that 2007 period where you made a high early in the year and then dropped into the summer. That sort of unnerved the Fed a bit, by the way, even though they were denying that there was any mortgage problem. And they cut rates in September. You went up into October, marginally beyond prior highs. And earlier in 2007, you got up to 1575. So you took out even the 2000 high, 1550, the dot-com high, by 25 points. I got 0.5%. And that was the top. So sometimes the stock market labors that way. Like, make its peak and then just boom, it's over. It fools you. I don't know why that is. I think it's the persistent belief structure that a lot of investors have that it always goes up. And therefore, it's hard to kill them. But once you do the initial quarterly momentum damage, in the case of NASDAQ, some annual momentum damage, it says, no, you're through. You pick the time you want to go down, but you're going down. I suspect if you're in the stock market, what you need to watch right now is not the leading Mag 7, which, as I've argued, spread-wise, haven't begun to deteriorate versus the S&P. But watch that bond market, government bond market, and watch that dollar. Because again, a large percent of the ownership in the U.S. stock market has moved to European hands the last few years. You kick that dollar downstairs about 5 or 10 more percent, and that hits them in the gut by 5 or 10%, even if the S&P stays steady nominally. So that could be a factor in helping to destabilize the stock market, which is usually not the smartest market around anyway. But I think the central bank right now is not so much concerned about the stock market as they are in debt. Not just the government debt, but they know that certain arenas of the stock market, there is heavy debt-laden situation, commercial real estate being prominent, where they are impacted by the strangle effect of long-term debt rates, 30-year bond rates, for example, which have not relieved them in the least. Since late 2022, long-term rates have been at a choking level, and they're getting no relief. And if you drop bonds much below the low we just saw, which looks like it's being artificially defended, by the way, central bank worried about something. You get down below that level, you could get a downside spike that creates headlines. meaning an upside spike in rates, and destabilizes market arenas that the public hasn't have their eye on right now, like commercial real estate. Because if commercial real estate starts to stumble, it's the borrower. Where's the lender? The banking sector, okay? So quit watching NVIDIA is our suggestion. It's lamer than the market. If you run a spread of the banking sector relative performance versus the S&P, go back 10, 20 years, you'll see, it really never got off the mat. It's gone up with the market, but on a relative basis, it's never resurrected itself. And over the last several days I've noticed that even the broader financial sector, which includes asset managers, insurance companies, and banks, it's been pretty lame. S&P keeps going up 0.5% a day, and it's just sitting there, like a no heartbeat. So we're watching other sectors. And again, I would watch outside the market. Because what happens in that T-bond market, we've had decades of error, compounded. You can't keep doing that forever and not pay dues. This is why Jamie Dimon is very upset, about the government bond market and the likelihood of recession. I think he's dead on, because technically I agree with what he thinks fundamentally. But watch those other markets like the dollar index. Like I said, 98.35. You close the month below there. As far as I'm concerned, the trapdoor opens. And that could create wave selling effects in the stock market, which, everybody thinks it's only tariffs now, right? That's the only thing that matters. No, it's not. That's an excuse. And by the way, when markets top like that, the stock market, it's rarely ever the headline you're focused on. It's suddenly, oh, something over there I didn't think about. Oh, this bank went under. But what's that got to do with the internet? Same story here. There's a lot of debt-laden problems out there, not only with consumer debt, but large commercial debt. And you can't afford to hear rumbling coming from that sector due to the stranglehold of high-end, long-end rates, because it will have wave effects. Who cares about AI? You can't afford to have the ambush come from other places. And I think it's about to.